Firstly, welcome everybody that's on the call this morning, and thank you for joining us on this morning's webinar around cash flow forecasting. This morning's session is specifically for all of you on the call, our existing customers. Some of you may already be familiar with IBM Planning Analytics, or TM1 as we refer to it. It's easier to say. You may be at various stages in your journey with TM1. Some of you may just be starting out, and some of you may have been using the solution for quite some time already in your businesses. There will probably also be some of you on the call this morning who don't currently make use of TM1, but are potentially considering it for your businesses and how it can potentially add value to your business processes. So just to introduce us, I may be acquainted with some of you already, but if not, I'm James Carr. I head up the sales team at IOCO, the data and analytics team. We're formerly Synergy, so a lot of you on the call will know us as Synergy. It's still the same business, and you'll be aware that we've recently gone through a rebranding at DOH, and we're now called IOCO. And with me on the call this morning, my colleague Chris Hewitt, who is one of our senior consultants and our FOPM solutions manager. Chris has got a lot of experience around the solution, and this morning we're going to take you through using planning analytics for cash flow forecasting, really as a bit of an insight into how you'd be able to extend the use of the solution that you potentially already have into areas of your business that can add much value, especially at a time such as this that we find ourselves in. And hopefully this morning's session is going to be of value to you all. So thank you very much, and without further ado, I'll hand over to Chris. Oh, sorry, before I do that, just to let you all know, there is a Q&A section on the call. If you do have questions during the presentation, please feel free to post them there. We'll do our best to answer them during the session, but also please feel free to get in touch with us after the session, and we'll address any questions you have there or discuss how we may be able to help with your cash flow forecasting. All right, so over to you, Chris. Chris, I'm not sure we can hear you.
Apologies, guys. Let's take two on this. James, can you guys hear me now?
Yes, we can hear you now. Thanks, Chris.
Perfectly. Thanks for that. I would have given the whole demo in silence. All right. So, guys, just to firstly, thank you for joining us today. And I'm sure this session will be of interest to quite a few of you. Obviously, cash flow forecasting has always been an area of interest in the business. Liquidity is always a key metric and something everyone has to watch very carefully. And obviously, during current economic times, it's become even more pertinent. So there's been quite a lot of interest amongst many of our customers to extend what they're currently doing in TM1 from a budgeting and a forecasting point of view, and to use the modeling capability in the tool to start leveraging additional ability and getting a good handle on cash flow forecasts. So in terms of the structure of the session today, I'm just going to give one or two high-level slides about the cash flow forecasting model, the considerations, and the demo that we're going to be showing you guys. So it's very much light on the slides. I've only got two slides, so just to set you at ease right now. And we're going to jump into all the good stuff in the form of a demo. And we're going to play around with cash flow forecasting and take TM1 or planning analytics through its paces. So the first slide over here is just to talk about the considerations that most people need, most organizations need to factor in when they're doing cash flow forecasts, and there are quite a few of them. So a couple of examples over here are reading from the top, your normal forecasted or budgeted revenues and costs, and obviously driving your cash flow forecasts. But the most important driving factor is going to be your actual income statement or balance sheet forecast. So that typically is obviously going to be the starting point. But from there, obviously, we need to convert income statements and balance sheets forecasts into the cash flow implications of those forecasts. And that's where we need to bring in all sorts of other factors above and beyond what many of you already have in place for your budgeting and forecasting solutions. So considerations such as your stock levels. So if you are budgeting or forecasting sales, you'll need to look at your current stock levels, and basically you can work your way down your supply chain to see how much stock you need to order or to produce, and obviously the cash flow implications of those purchases. So stock levels need to be considered. You obviously need to look at payment for workers. So a lot of us, unfortunately, have also had some salary cuts during these periods. And how is that going to affect your cash flow and your liquidity? And that's a key factor. A lot of organizations have done that, and that's really to ensure that the business remains liquid and profitable and a going concern into the future. But exactly what do you need to cut, and how much do you need to cut it, and how long do you need to keep cutting it for to ensure that your business remains liquid? Payment terms to creditors and suppliers. This becomes more challenging, and the normal credit terms that most businesses have been held to in the past have been relaxed a bit to keep everyone going and moving forwards. So from a creditor's point of view, a lot of businesses can't afford to pay on time. And similarly, from a debtor's point of view, a lot of your debtors are not going to be able to pay you the way they used to, and some of them, unfortunately, will not be able to pay you at all. So how do we model that? We can look at loan repayments that are due, renegotiate terms with banks, factor that into the cash flow. We can look at exchange rate fluctuations and also CapEx as well. I mean, obviously, CapEx in these times has typically been revised quite a lot while everyone tightens their belts. But how do you actually bring all of these factors to bear and do what-if scenarios to determine what you need, what levers you need to pull to ensure that your business remains liquid going forward? And for those of you that are familiar with TM1, you will know that it's an incredibly powerful modeling tool, and it's an ideal piece of software to actually model these factors in and do scenario analysis and plan your business going forward. Okay, so for today's demo, what we've done is, rather than trying to use some sample software from IBM, which often doesn't contain a huge amount of detail and is fit for purpose for demos, but is not as comprehensive as the real deal model, if I can call it that. So we've gone for the real deal over here, in that we have, with the kind permission of one of our customers, the Bearing Man Group, used their model to actually drive this demo. And obviously we have randomized the data considerably, so the data might seem a little bit strange in terms of the numbers. That's intentional, so please don't read anything into it, and please don't go and buy and sell Invicta shares on the basis of the numbers that you see here. So what you see over here, before we jump into the demo, is a high-level bird's eye view of the model, just to give you an idea of how it fits together, so that I can give some context as we start pulling levers and adjusting numbers to produce the cash flow forecast. So the model that we have here is one that is a model that we took quite a few years back, so it's actually evolved a lot since then. There's a lot more exciting and cool stuff that we have, but certainly will suffice for today's demo. So the architecture here is similar to probably what a lot of you guys have, in terms of how you have a whole lot of detailed cubes where you do your budgets and your forecasts, and all of those will then feed into a general ledger that's obviously at a TB kind of grain, and your detailed budgets, like your revenue budgets and your payroll budgets, will have all the modeling functionality and detail down to the most granular level that you would use for budgeting. So sales at a customer and a product level, payroll at a detailed employee level. And all of these cubes link to each other. So sales, obviously, you change that, your commissions change in your payroll cube. So all the normal good stuff that you're familiar with in TM1 that allows you to dynamically budget, change numbers, and see the final effect straight away. So we started off with the conventional budgeting model that we produced for Bearingman Group, and we used this to then enhance it and add in some functionality for cash flow forecasting. So besides the usual suspects of the revenue and the income, the revenue and payroll cubes and capex cubes and items like that, we then started adding in some more parameters and a few more cubes to allow us to move that forward into a cash flow forecast. So for example, we brought in a debtors cube. So we hadn't really been modeling debtors yet for just for debtors analysis, which you could do anyway by the by. But we brought in the debtors book to allow us to look at the current debtors book and basically predict and capture our expectations regarding how much of our current debtors book is going to be paid and when it is going to be paid. Because once again, we in a situation where the economy is certainly not business as usual, and we certainly need to consider a lot of variations and fluctuations compared to the economy in pre-COVID times. So we've got a debtors book. We brought that in as an extra cube. We've got also payment terms for our customers, for our debtors. So going forward, besides the current debtors book, as we forecast and budget our cash, our revenue going forward, what are the terms that we're going to expect? So at the moment, everyone's on 30 days, but let's be honest, not everyone is paying 30 days in these times. We also, from a creditor's point of view, all the various expense accounts that we have, we can also assign payment terms to our expense accounts and the expected cash outflows that we will have for paying those accounts that we will have. And then we've also brought in a whole lot of other parameters as well to allow us to drive not only the pure income statements and balance sheet budgeting aspects, but anything related to cash flow that will deal with this, such as VAT payments and the VAT lag factors when you pay your VAT, all those kinds of considerations. So we took the old, in terms of our demo model, as an income statement demo model. We built in the cash flow modeling behind it, and what we've got to show you today is the kinds of things that we can do for cash flow forecasting. Just a disclaimer at this point is that there are obviously many ways of doing cash flow forecasting, and different industries will have different considerations. You'll have different considerations in manufacturing businesses, businesses that have got long supply chains. Those will differ in terms of the considerations that you might have in the banking and financial services industry, the call center industry. So as you know, in TM1, it is not a modular solution where you buy TM1 and you have a module for sales budgeting, for income statement reporting, and one for cash flow reporting. You would have seen through your engagements with us that we start with a blank canvas. The analogy we use is a blank Excel spreadsheet, and this diagram would have been a blank screen to start with, and we will then craft a solution that is completely customized and fit for use for your business and for your industry, and also just for the way you tackle cash flow forecasting. So this is just a glimpse of what you can do with cash flow forecasting. We've built quite a few dynamics and parameters into it, but by no means has this been an attempt to try and produce a cash flow model that factors in absolutely every aspect behind it. But it certainly should give you an idea of how well suited TM1 is to cash flow forecasting. Okay, so enough talking, you'll be glad to know. And let me just flip screens and get to my demo model that I have running on the cloud, and let me open this up. So James, just to confirm from your side, I'm still not talking to myself. Everyone can hear me and see my screen.
Yes, Chris, I can hear you, and we can see your screen.
Fantastic. Okay, so I'm going to drive most of the demo today with TM1 Web and Workspace. Obviously, Excel is the tool of choice for many of us, but I thought let's get a bit flashier today and let's basically show you all the modeling stuff with TM1 Web Sheets and also Planning Analytics Workspace. So I'm going to go to my demo folder, and let's firstly go along over here and look at the free cash flow section. And I'll take you through some of the parameters that we capture to drive the cash flow modeling. So what I'm going to do is I'm going to take you through all the parameters that we have to play with, all the levers and dials and buttons that are at our disposal. So I'll show you them first, and then we'll start playing with them and moving them around and doing what-if analysis, and yeah, just having a good session to do scenario analysis. So some of the parameters that we're going to look at here are going to be account mappings. So this is really just a list of all the income statement accounts that we have over here. And what we're able to do over here is for every single account, we can set the term of that account. So you can set it to 30 days, 60 days, 90 days, and that will obviously determine when the cash outflow is going to occur, especially for your expense accounts. We then have parameters to indicate whether it is a provision or an accrual. So in converting, if I can call it that, your normal income statement into a cash flow statement, you're obviously going to take out things like depreciation, which are not cash flow items in the current period. So we will be able to set parameters here. We can also then obviously indicate whether an account is VATable or not. And obviously VAT is going to have a big impact in terms of moving your income statement into a cash flow statement. So obviously we're going to look at the inflows from VAT collecting on our revenue. So we're going to have a net input-output a movement from VAT in the current period, and then obviously the SARS payments is lagged typically in the following period. So all of that then is driven by the parameters that you set here, and once you set these, your cash flow forecast updates automatically and calculates all the lagged movements. The other key driver of obviously of everything in your business, but cash flow as well, is your revenue budget. So what we can do over here is start playing around with the terms for all of our customers. So optimistically, at the start of the year, we did our cash flow forecasts based on a 30-day payment period. But obviously that needs to be reassessed, and we can set customer accounts, specific customer accounts, and change the payment terms on that. So we could go to some of our big customers, change the payment terms. We might renegotiate terms, and you can go right down to an individual customer level and change the payment terms, and that will automatically ripple through and change your cash flow statement instantaneously. So we could, change the terms at a global level and push it down, or we can choose specific accounts where we might have customers who are under stress, and we've got arranged payment plans, and we can get quite specific in the terms that we forecast going forward for future revenue. Okay, and then what we have here is some more templates to capture information. So I have my my debtors book that I would bring in. So in this scenario, we've kept it fairly simple, and this scenario is one where we are starting to budget the cash flow at the end of one financial year, and we're moving into another financial year. Obviously, in reality, you'll have moving forecasts during the course of the year. But in this scenario that we've got, for demo purposes, we've kept it fairly straightforward in terms of the periods that we are looking at. So we are sitting currently at the end of March. The new financial year starts in April. So at the end of March, we will import our debtors book, and we will have a complete breakdown of all of our customers rolled up into different countries, into different branches. From branches, if we look at Pietermaritzburg, we've got different reps, and from there we've got different customers as well. So that is the debtors book as it stands. And then what we do is we can take that debtors book, and that's 15.2 million. So 15.2 million over here. So for our expected cash flow from our outstanding debtors at that point in time, we can then predict when we're going to receive the money. So on the right-hand side, this doesn't represent the aging of the debtors. It represents when we are going to expect to receive our money from the debtors. And we can do this at a global level. You guys have all seen how you can change a number at a high level and push it down. So we can change the total number. We can say, look, 15.2 million, we're not going to get that. So overall, I could just spread this down to about 14 million. And I can also change the allocation between the periods. But like I said, I'm going to go through all these parameters that we can use, and then we're going to play around, change some of them, and watch how our cash flows move month to month during the course of the year. Okay, so that is the debtors book, and then what we can start looking at before we look at the income statement itself. Obviously, the revenue, the movements and the lags from the debtors book and from our budgeted sales are going to affect the cash flow effect of our revenue, and that will feed into the income statement. But just to sort of show you the logic behind the cash flow movements from our sales process itself. So if I open up a template over here, I can see that I've got all product divisions over here. So I could also click on this and set it to a different product division. But in here, I can then see how, as we stand at the moment, where all my debtors are set to 30-day terms, how the cash flow lag affects. So for the whole of South Africa, and we can drill down, you can see we've got a budgeted cash flow, revenue in April of 8.1 million. You can see the cash flow effect comes through in the following month in May. Similarly, in May is 8.9, it comes through in June. So this will basically just shows the effect of the cash flow movements if from changing any terms or from changing our budgets. You can go here, drill down, and actually see customer by customer how it moves, or at a global level you can also check it out over here. All right, and then in terms of once we've done all those parameters, so we're at the point we've done our budgets. You know, we've punched our budget numbers in, we've captured cash flow parameters, and just to see how this plays out into a cash flow report, I can open up my cash flow report, get some more real estate over here, and we can start having a look at our numbers. So you probably remember a global number of 120 million that we had, and we can see how the sales numbers move from period to period. So you can see over here, if I expand on my sales account over here, you can see that firstly for April, the cash flow coming in is not from the sales account. So obviously this could have been plumbed to the previous financial year, the forecast in the previous financial year, which should have been March. But what we did for March is brought in the debtors book at the end of March. So if you remember, we had 15.2 million, and we spread that. We predicted that we'd receive 13 million in April and 2 million in May. So you can see the debtors book kicking in over here. For other months, you can see again the lag factor kicking in over here. So you've got, for example, budgeted sales 3.3 million over here for bearings, and you can see the cash flow effect pops through in the following month. So all of our information then is driven by this to produce our cash flow statement. And okay, that's sales. And then that same logic applies all the way through. So once we've set the parameters, the cash flow is calculated for us. So if I just look at another example, head office costs, okay, I can see over here, let's look at some of how the costs come through. So for the previous screen where I had my chart of accounts mappings, or chart of accounts list, should I say, of all the detailed accounts, I set up the mappings. So in there, I actually set, I changed one or two from 30 days just to illustrate it. So account 54014, our supplier for all our Wayne and land stuff, I set to 60 days because we've negotiated a deal. So you see the lag factor kicks in over here at 60 days. Audit fees are set as a provision because that's accrued every month and that gets paid later on. So we'll see how this works later on. So I set that as a provision, so it takes it out completely in the first instance, and then further down we can capture the cash flow effect in manually as we see fit. You can also set that up on a formula basis so that you can kind of have the cash flow implication occurring 2 or 3 months after the actual expense was incurred. So you can kind of you can follow either approach for different accounts depending on what works for you. Okay, and then if we go back down here, let's close down head office costs and scroll up. So this really follows the format of obviously of a management accounts income statement. So we've got operating profits, operating profits, got the budgeted cash flow impact of it. We've got audit fees, which we can capture manually. We'll look at that on the dashboard fairly shortly. And then we have some timing adjustments. So in here, sorry, balance sheet timing adjustments. So I had grouped these as timing adjustments for the income statement. Again, I'm sure you guys might report or classify your cash flow movements a bit differently, but this is just what we did for demo purposes. So timing adjustments here for income statement, and then some balance sheets timing adjustments over here. So VAT input on capital expenditure. So we've got as part of the budgeting process, and again, if there was time, I could show you all of that as well. We've got a CapEx module where for the budgeting process, everyone captures the CapEx. And you know, as we know in TM1, the fantastic thing about it is that you can link and model everything together. So the obvious thing to do is we can grab the CapEx expenditure that we have for April. We calculate the input VAT on that CapEx expenditure. So we see the VAT coming out. We have the net VAT effect from net input and output from the income statement appearing in that month. And then what you will have is the SARS payment is automatically formula driven to calculate a month later. So net of these two items here, the SARS cash flow item appears in the following month over here. So that is how VAT gets modeled, and again, all done automatically. So you change a number, change your income, everything recalculates, your VAT recalculates, and obviously flagging of VAT accounts is also critical to get right to do this. We then have cash generated from operations. We then have other items like we have dividends received, subtotal cash from operating activities. We then have CapEx. So all the financing items that we have over here and expenditure items. So this is the CapEx again drawn from our CapEx budgeting process. So if your cash dips too much, you can go in and decide in which particular month you need to change your CapEx to get your closing balance, obviously in a positive state. We then have loans, loan amounts as well. I mean, you could obviously have any other capital items that appear here. And then we have a net movement for the month. We have an opening balance and the closing balance. And then, as you'd obviously expect, the closing balance becomes the opening balance for the following period. and then obviously this flows all the way through for the rest of the year, and you can then obviously model your cash flow movements month by month. At a global level, we can have a look for the, well, should I say at an annual level, we can have a look and see that the total movements that we have, we can have, we then have our opening balance, and then we have our closing balance as well. Obviously, there are many other considerations, like I said in my other slides. You know, this is not meant to be a model that builds in every single item or business process that relates to cash flow movements. So you'd obviously consider things like intercompany transactions as well to make sure those don't all distort your cash flow numbers when you're looking at it for individual companies or across the group. But yeah, you can see your closing balance over here is 5.4 million, and if we scroll to the right, we can see that 5.4 million over here. Okay, so those are all parameters. So let's now go and play with some of those parameters and see how the cash flow can move. So if I go then to my desktop and I open up Workspace, let's have a look at that and have a look at the numbers from a dashboarding point of view. Just nicer to look at and easier to play with. So I'm not sure how many of you guys are actually using Planning Analytics for Excel, but it's certainly a tool, again, that is designed to be used by the end user. So you can go in here, you can set it in edit mode, you can add multiple tabs, you can create reports, drag them on, and then as you change various parameters, you can see the effect of those changes and how it's affecting your bottom line. So just waiting a few seconds here. So server is slightly underpowered over here, a lot of data to compute, but we'll look at our closing balance trend in a couple of minutes over here. So there we go. Once it caches all, we'll be good to go. So we're not going to be watching things moving around every single screen. So what we can see over here is in this graphic over here, you can see your cash flow balance. Oh, there we go. We're all good now. So we can see that we've got our cash flow balance and how it moves per month. And what I'm going to do today for scenario analysis is use the sandboxes. So for those of you who haven't used them, you can set up multiple scenarios using sandboxes and compare the effect of different scenarios and stack them all up and play around with different scenarios in terms of the obvious one being in current times, how long you expect the lockdown to last will obviously affect your revenue predictions, and you can predict revenue as a scenario for that. You can have a low road and a high road scenario and anything in between. For those of you who've been using TM1 for years, not everyone uses sandboxes. They can be memory intensive, and you can achieve exactly the same thing with versioning. So we often, for our customers, we just have different versions that we copy to, we snapshot to, and then you can achieve the same thing. For slightly smaller models, you know, scenario planning does certainly work well. But for this demo, it's just nice to use sandboxes to display changes straight away. Okay, so at the moment, we've got just one scenario. So I've taken the liberty of just setting up one scenario, scenario one, which is exactly the same as what we have at the moment. And we can play around with those scenarios. So this shows us our cash flow movement. We're still positive at this point. We have, sorry, that's the cash flow balance. We have cash flow movement. So we can see month on month, the actual live budgets numbers that we've calculated and live cash flow numbers, but we can go and within a particular scenario change any parameter. So all these parameters, we can change the actual, if I can call it, live version, or we can change it within the scope of a scenario and leave the live version intact. And once we're happy with the scenario, we can commit it to that live version. We then have cash flow details. So similar to that sheet that I showed you earlier, where I showed you how the budget translated to the cash flow movement. Simplified it slightly here, and I've just got the cash flow movement over here, and there's that closing balance at the end of the month, and I'm just showing the month-to-month cash flow movements. We then have sales information over here, and we also have the ability to capture debtors information. Again, we can, rather than capturing the base version, we can choose whether we want to capture this as the final cash flow version, or we can capture it within our scenario. We then have manual adjustments where we can manually adjust cash flow movements. So if we dip below, if we dip into overdraft in a particular month, we can go and punch in information where we raise additional finance to actually counter that. So let's play with a few numbers. So the sales summary, for example, I'm going to make sure over here that I am set over here. We've got scenario 1 that we are looking at over here, and I can go in here and I can change my scenario. So let's say, look, 120 million was what we were expecting, but with lockdown still carrying on, I want to change this to 110. I can go down, drill all the way down to an individual customer and change it, but as you guys know, spreading is a great feature in TM1. So I'm going to go here to spread data, and let's say, okay, well, let's be less bullish about this and make this 110 million. I can apply that. Okay, and as I apply that, so the income statement cube, this is in the income statement cube down to a customer and a product level. So this is obviously linked to my general ledger, and that's obviously at an account and cost center level. So you can see a little, you can see an income statement coming through over here. You can see your profit for the year, and the sales is matching that 110. And then obviously, if you want to go and look at the closing balance, we can click on the closing balance, and lo and behold, you can see how in scenario 1, our closing balance has dipped to 2.7 million closing balance over there. And we've got a bit of a worrying situation over here, where in August, we are going into negative 100,000 on the cash side. So we could go there into August, for example, and say, right, for August, we're going to raise funding for 200,000. Capture that information over here. And then once we've captured our information here, go back over here, and you can see August, we were minus 100,000. We're now going up 100,000 to do that. And then, for example, we can look at our debtors payments too. So the debtors payments at the beginning of the year, 15.2 million. Well, to be honest, it's unlikely we're going to collect all of that. You know, our bad debt provision needs to be fairly substantial. So I could go in here, plus I'm on scenario 1. I can go in here, change this number over here, and do a spread, and change this number over here, for example, to 14 million. Apply that. Okay, and then if I go back to my closing balance over here, I can see that my numbers have shifted once again over here. Okay, so all of these parameters we can play with and alter. We've looked at debtors, changing debtors. We've looked at manual adjustments. We've looked at changing the sales numbers. Remember that we can also go in and change items over here, such as the terms, the customer terms. So you might decide over here for a particular customer that you have, you've negotiated new payment details, and you might want to go in and change the terms of a particular customer that you have. So you've got your full debtors book over here, and you can literally scroll through and change any customers that you want. So for example, over here, Hillside Aluminium over here, I could change this number over here from 30 days. Let's change that to 120 days. Okay. And actually change that against my base version, which is fine, I guess. So if we went back to our base version, which is our live version over here, your closing balance should also update based on that. And yeah, that should hopefully, I think we're sort of running out of time. We're almost at the end of our time span, so there's a lot more I could show you guys. So I'm going to flip off the demo now, and if there's any time for Q&A, I'm happy to take any calls that come through now. Yeah, thank you. Sorry, before we go into the Q&A, our memory has escaped me over here. So just one other thing to mention in terms of the solution that we deliver. So it's built from the ground up. So that's always the case with TM1. So you guys are familiar with that. No modules you have to try and force fit to get to work for your organization. You've got scenario planning capabilities. You can integrate with your existing systems, import data from your ERP systems, any operational systems, agricultural systems, your user interfaces, Excel and web. All your data is held in a single repository, a single version of the truth. Cash flow forecasting and so much more. So we do the normal budgeting, forecasting, and financial reporting. We use TM1 models for all sorts of other operational areas across the business, from logistics planning to production planning and anything in between. And then in terms of the service that we do, so obviously this is not a plug and play solution. We spend a fair bit of time engaged in data discovery to understand your business. We then craft and implement a solution based on your requirements. We train you on the use of the solution, and then we with you guys into the future as part of the journey you follow to give you continual operational and strategic support and help you make the most of your solution and also enhance your solution and also extend TM1 into any other areas of the business, because we certainly believe that an investment in TM1 can be leveraged across many areas of your business. So as existing TM1 customers, there generally are many areas where additional value can be derived. Okay, thank you guys.
Great, thank you very much, Chris. So if anyone does have any questions, so I've got a bit of feedback, Chris.
Okay.
Thanks. So if anyone does have any questions, can you just maybe mute Chris?
Sorry. I thought you meant you had feedback from the customers. My apologies, James. Okay, so on.
Okay, so if anyone does have any questions, please feel free to put them up in the Q&A section. Chris, there was one question earlier on in the discussion. I'm not sure if you can view the Q&A panel, but can the terms be imported from your accounting system on customers and suppliers?
Sorry, struggling to unmute. Absolutely is the answer, and that's typically the approach we'd follow. All good there?
Yeah, all good. We'll just give a few more minutes for people to type out any questions if they have. And just a note that the recording of this presentation will be made available to everyone who attended today. So there should be a mail that will go out from Priscilla post the session with that. All right, so we'll just wait maybe 1 or 2 more minutes if there's any further questions. But yeah, to everyone that's still on the call, thank you very much for for joining us this morning. As I mentioned earlier, this session really is about helping you all as existing TM1 users understand sort of other areas of the business that you could extend the use of the solution into. Many of you use TM1 for budgeting and forecasting and financial reporting. There's some that use it for activity-based costing, logistics planning, production planning. But really, if cash flow forecasting is not something that you're currently using it for, and in the times that we find ourselves in, the ability to forecast and plan your cash flow effectively would be useful, then we'd be very happy to discuss further with you all how we can help you do that using the tools that you already have at hand. All right, Chris, doesn't seem like there's any further questions coming in. If anyone does think of any questions after the session, please feel free to drop us a line. You've got our contact details, and feel free to get in touch. All right, so I think that brings us to a close. Thank you, everybody. Thank you for joining us this morning. I hope you found this morning's session valuable, and we wish you all a great Friday and a happy weekend further. Thank you very much.